Right. Yes. So as I was saying, we will just walk through from A to Z of it because we are familiar with everything. And most important, I will we will be more practical. I will want us now to do the assignment that we gave you from the initial stages. We will do it together from marking the highs, lows, to seeing what trades, what opportunities are there, and how would you have managed them, because that is exactly what we should be able to do at the end of the day. So I want to believe that we will be keen, we will work together, and you will be asking questions. You can ask, prompt me to pause, so that you can be sure at the end of it, at least you can be comfortably to be able to put all those concepts together and be able to really to trade comfortably and be able to do this swing trading. So without much ado, swing trading, as we all must have known, swing trading, which will involve holding on a trade for several hours, from several hours to several days, for as long as it is still, on the positive side. Yeah. Swing trading, you will only exit. You are supposed to, because remember, it is a rules-based trading system. So meaning then that you will only be able to exit the market if certain conditions are met. That is the only way you exit the trade is through if your stop loss is actually hit. Yeah, that is ordinarily how it should be. But of course, as we will come, as you get comfortable with it, and as you will come to learn, is that these rules are not cast on stone. These rules are expected, they are the basics that should inform you what decision making in this trading. But of course, it is expected you as a trader, you should be able to look at it and improve on the system for it to give you to be more productive to you in one way or the other. Yeah, so we should not take it like wholesale as it is, and that we cannot do anything, we cannot think on anything. No, actually, that is not even the spirit of the author of this trading system. He has always insisted that yes, he has done his best, he has tested this thing for so long, and he is comfortable with it as it is, but he keeps on improving it. And he also challenges us that we should also think and be able to study it and see what more can we can be, how else we can also be able to improve on it, so that it can give us an edge. So we should have that at the back of our mind even as we go about here, so that you don't look at it like, it is cast on stone. But that does not mean that, again, we should not follow the rules. The rules are basic, and they have been tested over the time, and they have been found to really help manage trades in a predictable way. So that may be a challenge I want to throw to you as you take up on the challenge, so that you don't just feel like my hands are tied, I cannot think through this thing and see what else can be done. It is yours. Actually, it is all yours for you able to explore and be able to improve on it. Like any good thing, good things can also be made better, and that is basically the theory behind this trading system. Okay, so this system from, let's remember, it does not apply to all pairs in the market. Yeah, there are those which have been tested, and they have been back tested over several years, and they have been found to hold true. These rules, they have been found to hold true, and therefore it would be not wise for you to use the same system to go and actually to use the same system to go and start trading another pair, such as like a Euro USD. It will be disastrous, I can tell you. So let us remain to what, unless you go and test other, you can try it, of course, you can back test on other pairs and see which works, but don't go trading on just another pair before you're back tested. But these two, AUD USD, USD JPY, so far they have been found to be good, but the best is actually AUD USD. Audi USD has been found to hold much better. Now, I want us just to briefly just go over what we have gone through. The first thing we know, this strategy is that it is trend following, meaning that you want to jump into, you want to catch a trend when it is starting, at its inception. That's when you want to grab it and ride with it all the way up to where it will turn. And again, you will want to exit it. You will want to exit that trend just in time so that it does not drag you down all the way. That is basically, you know, the thinking behind this strategy, to enable you to jump in with the minimal drawdown and go with it all the way. So meaning then that the starting point is that in the market you want to know what trading, how is the market structure? How is it trending? Is it a downtrend or is it an uptrend? That is the starting point. Because if the market has been going up, it is only it is obvious that it can't go all the way to the heaven. It will reach some point at turn, and that is the point at which you want now to get into the market, at the point at which it is turning, right? So first of all, as you enter the market, there is always a starting point, because the market, remember, has been going on. The market has been going on for since eternity, well, years back. So you are not, even if you are entering today, that's not the beginning point. So you need to look backwards in the last few days. How has the market been going? How is it? Is it ranging? Is it an uptrend? Is it a downtrend? Where is it? So that at least you have an idea. If it has been going up, then you should know that then now you are entering a market that is going up. So you should be looking for you know, the market to start slowing down for a downward trend, so that now you can position yourself in time. So trend is the first thing, that the starting point actually. Yeah, it is the starting point. Then now, once you have identified the trend, then what follows is a marking the start and end of an impasse. Because impasses, remember, we defined impasses as, you know, those, you know, it is a series of, it is the impasses which constitute a trend. Yeah, several candles which follow each other successively, which move in a certain direction. Then they reverse a little bit. Then again they peak there going onwards. So those impasses are they are like the beacons on the way. They are the beacons on the way as you climb that trend. And therefore, because there are points at which you pause, you want to identify them as you move, so that when you see them, then they are slowing down. They give you an indication. Actually, they give you a signal that, look here, the trend is slowing down and it wants to turn around. Okay, so you go marking high. You're marking the current highs, current lows. Current low is it marks the beginning of an impasse in an upward trend. Then the current high marks the end of it. Yeah, marks the end of it. Then what follows is that it will retreat a bit through by the appearance of what we call a counter trend candle. Then after that, if it is still moving on upwards, still it will again peak again, and therefore you'll be able to see whether it is losing momentum or it is not. And that's where now it brings us to point number 3, establishing an ascending and descending pattern. Yeah, as you follow your highs and lows, you should be able to identify, is the market losing momentum or is it gaining momentum? Because remember, when you are on upward trend, you want to know whether there is what we refer to as an ascending pattern. Ascending pattern is that slowing down of the momentum by the impasse, an impasse running down, actually moving down to touch the previous impasse. Yeah, it moves down to the extent that it actually touches the previous impasse, and therefore that signals you that the market is actually slowing down. And when it is signaling you, now it is telling you now, look here, be ready to take your position and place a sale, so that you can jump on a downtrend when it is starting. The opposite is true. when the market was going down, the descending pattern happens, then now it is preparing you to actually position yourself for a sell. Okay, so these are boxes that you tick as you go into the market. First of all, what is a trend? You identify it is an upward trend, tick. Then you go, if it's an upward trend, you start marking high, then you determine where is the low. You go, you wait for it for a counter trend to happen, then you mark the high, then you move downwards, and then you mark the low, moving with it like that. In the markings of the highs and lows, those are the ones which will be able to tell you, is the market still, is the trend strong, or is the trend losing momentum? Yeah, that is why we said from the word go that marking of those lows and highs, they are very important. They are actually the building blocks of this thing. If you don't mark them well, then a descending or ascending pattern will happen, and you will never be able to recognize that is actually happening. So it is so important that you must get them right, so that then you don't you don't actually find yourself missing an opportunity, or really, yeah, missing an opportunity and ending up not trading as you should. Yeah, so then once after establishing the ascending or descending pattern, as the case may be, then the next thing, the next box to tick is there a confident change of direction? Is there a confident of change of direction? Because remember, if these other boxes have not been ticked before, there was, for instance, there was no ascending. So even if there is a confident change of direction, it will mean nothing. It will mean nothing as far as this strategy is concerned. It must be preceded by, yeah, some people here bothering latecomers. Okay. Okay, I've admitted them. Now, so confident change of direction should be preceded by an ascending or a descending pattern. That must stick, you know, and you can't jump any of this. They are like, you know, they must follow each other in that sequence. They must follow each other in that sequence. You must be actually writing them somewhere and possibly even ticking the boxes. Yes, this has happened. Now, what the next one should be this. Then does it happen? How does it? If it's a confident change of direction, it should be, and yesterday, I think Ken was very, he tried to demonstrate clearly. I will not go there because already you have all the material about what it means by confident change of direction. You know, once the change of direction, the market was going up, it has lost momentum, now it is going down. So it is expected for it to show confident change of direction, that it will move down to break the current low or high as the case may be. The current current low, which because remember the current high or current low has been converted or it becomes previous, because when at the top there is still the current low, or rather at the top there is current high, or at the very bottom there is still there's a current low. But as it turns, then the previous current low becomes the immediate previous, or rather the previous high or low, as the case may be. So once it comes to break it, then how it breaks is what also matters. How the break, was it small? If it is a small break without wick, that one, it is taken as a valid confident change of direction. If it's a small break, but then there's no wick. But meaning then that if it's a small break and there's a wick, you know, at the tip of that candle, then that one would not qualify so meaning then that you will have to wait for the next candle and see how it behaves. If it comes out more forcefully, then now that one would possibly now convince you that would now be able to give you a clear picture that now there is actually a proper a confident change of direction. But if it's a mid-size break and it has some wick, then the body which is outside the break, it should be longer than the wick. the body that is the body that is below or above the breaking point, it should be larger than the wick. If the wick is longer, then you are not yet the change is not yet convenient, and therefore it will require you to wait for the next candle to see whether it will be able to fill that wick. If it fills the wick, or rather it comes out, the body will to be large enough to be the size of the wick that had been projected earlier. Then that would qualify as a confident change. But if it doesn't fill in, then that one it would nullify that change. If for instance, if it comes out and then it pulls back and there's another wick, then that one collapses. Now you can just forget about that. You just continue with marking your highs and lows, waiting for another for another series of the rules to appear. That is, you start seeing again either a descending pattern or an ascending pattern, as the case may be, so that now you can reposition again. Okay, so once it starts behaving like that, you get out, you just follow it. Then, of course, the other type of break is the large break. Yeah, large break with some wick. If it is large, if the break is large enough, then that gives you confidence. And again, this break, it may be, there was also the caution that if it is again too large, extra large, let me use extra. Yeah, somebody saying something? Okay, yeah, let's keep our mics off. If it is extra large, again, that is also a sign of danger. It is one of the watch outs that we were told. If it's too large, the extra large, not too large. Extra large is a candle that really it distinguishes itself when you compare it with the other candles which are around it. You can see it really pushed so far away, perhaps. And this one, most of the times it happens when there are news, when there are those major events which happen. They're the ones which resort to this extra large candles, and they tend to disrupt the market. Yeah, they tend to by the way, from my observation, is that okay, let's put off our mics, those who may be on. Yeah, so when there are news, they have a way of disrupting the market, and certain certain principles they no longer hold, and that's why you see it is actually a caution that when you see those large candles, they should not fool you into getting into trade, because many times they will not be able to materialize anything. So it is wise to just step back, wait for the market to stabilize, and then look for how you enter the market. It is wise. In this market, you just have to play smart. There is nothing that is guaranteed. This strategy, it is not the holy grail. Yeah, it is not the holy grail that once you have ticked all the boxes, then everything will fall into place. No, you also still have to look at the market. You also want to really be a rational trader. Be a rational trader as you make decisions, because all this is about decision making. You trade what you are seeing. Yeah, trade what you are seeing. Don't just assume that things will play out by themselves. Your role as a trader and your expertise and the experience will come into play also in helping the system trying to do what it must do, what it should do for us. Okay. So then, as I've said, if it's an extra large break, that one, please, let's be cautious about it. A large break is these are things that you will be able to determine whether it's large, depending on the environment where it is. Yeah, if it is surrounded by other smaller candles and it's bigger than them, then that would be said that it's a large break. But if then it is extremely big, then that is extra large, and we are cautioned to stay away or not to position ourselves, because they are likely to cause us trouble. Then now the trading plan. The trading plan, we looked at that. This is now how you enter the market and how you exit and how you manage your trades. How you enter the market and how you manage the trade. Because once you enter into the market, once you are triggered, of course, you have ticked all the boxes and you have placed your sell or buy limit. Remember, we use buy or sell limits. Okay, buy or sell limit is what you use. Somebody is saying they can't hear me. Does it apply to everybody or it is only Alphonse? Guys, you are hearing me?
Yes, we are hearing you.
All right, then Alphonse, it should be
very clear.
Yeah, it should be on your side. The problem, please check your gadget and your connectivity. All right, thank you. So then the trading plan is now when it comes to where the action should be. Because all these other things, at the end of the day, the ultimate goal is actually to enter the market, you know, in a manner that it is going to give you, it is not going to export, it's going to be the least risky, meaning that you are entering at a point where you will experience minimal drawdown. I want to believe we all know what drawdown is. It is those floating losses that happen immediately you enter into a trade. Yeah, if it was a buy you are doing, and then instead of going up, the market changes and starts going down, you start experiencing drawdown. And the drawdown is actually the measure of risk in trading. Drawdown is a measure of risk. How much exposure did you incur before actually you made profit? Yeah, because it is that exposure is the one which threatens your account. It's the one that is likely to wipe away your account. Yeah, so a trader, a good trader, a professional trader will want to trade to enter the market at a point whereby they will experience minimal drawdowns. That should be our goal. Because if once you manage the drawdown side of trading, then you can be sure that you will trade comfortably and the exposure to your account, your account will be protected and your trading will be less stressful. So that's why at the entry, we use limits, either sell limit or buy limit. Buy limit or sell limit. Why? Because the market, remember, there is the aspect of retest. Retest. The market, yes, it is going down. It is going to break to show confidence that it's going down. But it will not go on a straight line. Like now it is just starts running and running away and going. No. Okay, and as you know, if we will be kicked out, you remember to just come back straight away, so that I'm told we have about 10 minutes. By that time is when we go into the practical part of it. Okay. So then what I was saying is that we use the reason we use limit, either buy limits or sell limits, is to minimize on the drawdowns. Yeah, and because of the retest, once it goes down, it is telling you this is the way I'll go, but it will not go all the way. So it will come back to retest, and that's why now when it comes back, let it now go down with our trade or go up with our trade. That way we will have very minimal drawdown, and therefore now when you are in the trade, we will start managing that trade. How do we manage? We manage by scaling in. You know, you go marking your highs and lows, where you will be able to create a new impasse is created. It gives you an opportunity to move. It gives you an opportunity to move your stop loss. Stop loss is what is used for exiting this market. You don't use TP. Yeah, you don't use TP. That's take profit, but still you can do it. I don't want to believe that you should not use it, but you see, you limit yourself. You limit yourself. This strategy tends to take care of it. It is more of a defensive. It is more of a defensive strategy than offensive. You want to protect your goal, not to if you are going to be scored as few goals as possible. Yeah, you are not so much in. You are not, because you don't want to do so much of attacking, but you can protect what you have, and what you have is your capital. You don't want to expose too much of it. You say it's only 1% that I'm exposing, so that will help you determine your stop loss, where you're going to place it. All right, so that even if then the market, the drawdown comes all the way and it eats it, still tomorrow you'll be in the game. It is not like you'll be kicked out, right? So that stop loss is what will be used, and you don't move it. There's usually the temptation. I remember when we were doing our scalping, something we used to make a joke that, you know, when the market's going against you, you take the stop loss to Mombasa. Yeah, that is how accounts are wiped. When you start moving, because simply what it is telling you is that, you know, the buyers that you had, when you enter the market, there was a bias that you had all conditions were such that the market is exhausted and it is going in your direction. But then, if it proves you otherwise, do not start chasing it. Just be man enough or woman enough and stand back there and see your stop loss being hit without you trying to move it away. Yeah, don't do that. Don't move it even an inch. If you decided it's 15 pips, that was your 1%. Just watch there. You can say a little prayer, maybe before it is hit. Your prayer can be answered, and then it goes your way. Fine, but don't get into the temptation of moving the stop loss. You will be breaking the rules, and that's how you'll start getting into trouble. Okay, so it moves. Then you will be trailing. You will be assuming that the trade goes your way. You will be moving the stop loss, trailing the trade at a distance. You will be trailing it at a distance informed by the new imbases that are being formed as it continues. And also, once you have secured the initial the initial risk, that is, once you have gone beyond the break-even point with your stop loss. I want to believe that you understand what I'm saying when I say break-even. Where you enter the trade, you remember you had 1% as a stop loss. If the market has given you enough room to be able to move now into the profit territory, such that you have secured your some profit, or even at worst, you are at the entry point. Then now, that way, it gives you now room to scale in. To scaling in is to actually take additional trades as you move down. To take scaling in is taking additional trades as you continue moving the initial stop loss downwards, and again taking additional trades so that you can magnify the profits that you're going to make at the end of the day, because now you are certain that actually the trade is going your way, and therefore you can now confidently be able to scale it up to a point whereby you are going to see that the market is slowing down, or the momentum is actually weakening. Because that one, as you remember, it is a signal. That is a signal that you need that the market is going to turn. And you don't want to scale in when the market the indications are clear that actually the market is going to turn, right? When there's no momentum, you don't scale in. You just continue managing the existing trade until the market turns and comes to eat your stop loss at the point at which it had moved up to. Then now you start now looking for a different opportunity, or rather an opportunity in the different direction. Because by the time that your stop loss is hit, it means the market is now changing direction. Yeah, it will mean that the market is changing direction, and therefore you can now look for opportunities to re-enter the market. If it was a buy initially, then now you want to look for an opportunity to enter for a sale, so that now again you can move with it upwards. Okay, so basically that is how the trading, how we go about the trading, entry management, and how you exit. Exiting is only through stop loss. All right. Then identification of the red zone, watch outs. Those ones were humbly covered yesterday by whatever. I just repeat them for the sake of it. Long wicks, a red zone, of course, it's when the market is consolidating. Remember, this is a trend following system or strategy. And if you're following the trade, then you find yourself in a ranging market. This is what you're calling the red zone, one which is bouncing up and down. There, the nature of this strategy is that you should not get involved. Yeah, you should stay away from the market. You just keep watching it until it breaks the current high or the current low. That's when you get involved. those in the place in between, you just sit back and watch. Yeah, because once you start getting in there, then you'll not be using this rule. And actually, there are no rules. The only rule that exists for the red zone is stay away, unless an extra large candle happens. Yeah, you just stay away. And how do you identify it? This red zone. One is when you are seeing long wicks above and below the candles. When you're seeing so many long wicks up and above, that should signal you that actually you are in a ranging market. A ranging market, a consolidating market, it is what we refer to as a red zone, right? So what does it signify? Those long wicks and above and below, the long wicks, they signify there's pressure. Both the buyers and sellers, they are kind of at a state of equilibrium. There is none who is pushing us more weight than the other, and therefore they are in a seesaw kind of situation. Seesaw, one goes up, down, down, up, down, up, down. No one is going all the way until one will overpower the other, right? Until one will overpower the other. So that is one indication. Frequent change of direction. If the market, you see it in a songa kidogo, it goes up a bit, then again it turns down. It goes again, turns. Those frequent change of direction, they are an indication of a red zone. Again, the other one is an ascending pattern immediately followed by a descending pattern, and vice versa, right? When an ascending pattern happens, ordinarily, if all factors hold constant, it is what we expect to follow is a confident change of direction, right? And when that confident change of direction happens, we expect that it will go down, and then it will come and retest. But then it's not always. Sometimes we can have the ascending pattern, but then after instead of a change of direction, then you start seeing a descending pattern. You start seeing a descending pattern, yeah, which is opposite of what you are expecting. So when that follows, it should allow you to stay away and just mark your high and low and let it do the interplay until it's done. So the red zone is broken when two candles close above or below the zone. Okay, when two candles close above or below the red zone, that is when you